And we're not done building and saving for the future, and we're in the wealth creation business. And the fourth one says, "Listen, I've gotten rich enough. I'd rather take some money out." And well, there's only two ways to do it. We can pay dividends, all four of us, three of us of whom don't want it, and we can repurchase the shares at a fair price. If it's just the four of us, we pick out a fair price, and the fourth one gets bought out of his interest. I find it almost impossible to believe some of the arguments that are made that it's terrible to repurchase shares from a partner if they want to get out of something, and you're able to do it at a price that's advantageous to the people that are staying, and it helps slightly the person that wants out, and a majority of the Berkshire shareholders, a great majority. We had a vote on dividends one time. We've got savers. Now, that's partly because we've advertised ourselves as being that sort of a vehicle. We've created that something. We've stuck with it for 50-something years. And people look, individuals, huge number, look at Berkshire as something they're going to own until they die. Now, their circumstances may change, their needs may change, but the savers generally keep saving. We just recently had somebody that father came with us 60 years ago, and billions of dollars, and they weren't saving exactly for their old age. Just was sort of built into them that they like to do it. Now, philanthropies will get a lot of money and so on. It's the most. What could be more logical than if a very small minority of your holders want to get out, and most of them want to stay in, and the person who wants to get out wants the money. You don't give the money to everybody. You give it to the one who wants it, and you do it at a price that is beneficial to most parties. On a private deal, you'd work out the fair value. The market tells you the value in the case of a publicly traded company. Charlie, got anything?
Well, if you're repurchasing stock just a bullet higher, it's deeply immoral. But if you're repurchasing stock because it's a fair thing to do in the interest of your existing shareholders, it's a highly moral act. And the people who are criticizing it are bonkers.
Okay, this comes from Gary Gambino. He wants to know if Berkshire would switch its capital return policy to dividends from buybacks if the capital gains rate goes up to 43.4%. Dividends would be far more tax advantaged for shareholders under that scenario.
Yeah. We literally did have a vote by our shareholders. Now, we've got a different group of shareholders than a REIT would have, or an MLP might have. I mean, there's different. People select what they go into, and people that go into SPACs are hoping the stock goes up next week, basically. And we've got a bunch of people that were assembled over 55 years, but they started with a base of people that it was a lifetime investment. And if they wanted to cash out, they thought they'd get a fair price at that time, but they really didn't. They had bought it with no intentions like that. So we had a vote, and it was something like 97% or something of the shares said they don't want a dividend. And now that wouldn't be true at other companies, and it'd be crazy to be paying a regular dividend like Coca-Cola has done for many years, and then all of a sudden change the policy on millions of people who had bought it with one expectation in mind and try and change it into a different animal. But Coca-Cola isn't going to change to Berkshire, and Berkshire isn't going to change to Coca-Cola. We've got a different group of owners, and it will keep self-selecting because people have a choice every day. Which do you want to, sort of thing do you want to be in? And Berkshire is a certain kind of animal in that respect. So we will not, if they jig around the tax laws, that's really got nothing to do with the decision. I mean, we've got a very substantial majority of people that want us to reinvest the money, and what they're more concerned about is whether we find something to do with the money, the $100 billion or something. And repurchasing shares is something that helps them. They own a larger percentage of Berkshire as they go along, and they'd love to see us buy another business, but they don't mind us intensifying their interest in the present business.
You got a lot of questions that came in on taxes, so I'll run through a few of them. We'll see kind of how many of you answer them, how many you answer before we get to them. But this one came from Arthur Lewis in Denver. What are your thoughts on the new administration's capital gains, corporate tax, and stepped-up basis tax increases?
Well, if Charlie wants to answer that, I'll be glad to have him do it. I long ago, many times, have said that I don't put my political opinions or anything in a blind trust when I take this job, but I also don't speak for Berkshire Hathaway. I mean, we've got people have very different views on taxes, and I've expressed some things in the past. I don't like to speak on behalf of when I'm sitting at a Berkshire Hathaway annual meeting, presumably speaking for Berkshire. I don't really like to get into political questions generally, and I don't really think I should. But I also think if somebody asked me who I vote for the last elections, a personal basis, I voted for Biden now. But I've never asked a single employee of ours who they voted for, anything of the sort. What religion? I am not authorized to go around signing my name as chairman of Berkshire Hathaway to proposals. If I write op-ed pieces, I do it as an individual. I try to make it clear. So I don't think I don't want to use the meeting to give a lot of views on taxes. Charlie?
No, but I think it's probably a mistake to be basically anti-capitalist. I think capitalism is what raises GDP for everybody. And I have also a feeling that Benjamin Franklin was right when he said that it's hard for an empty sack to stand upright. And to some extent, the prosperity of leading American institutions helps them behave better. Now, there are exceptions in promotional finance and so on, but by and large, Franklin was right. And so I'm a little wary of just constantly being mad at people because they have a little more money.
Charlie, there was a question that came in specifically to you on the tax issue. Over the years, and with emphasis in 2020, we've heard people leaving California for various reasons, such as high cost of living, high taxes, et cetera. I understand that you believe it's dumb for states to have policies and laws that provoke rich residents leaving, but what are your thoughts on those people leaving? What keeps you in California?
Well, that's a very interesting question. I frequently said I wouldn't move across the street to save my children $500 million in taxes. And so I have, that's my personal view on the subject. But I do think it is stupid for states to drive out their wealthiest citizens. The old people that don't commit any crimes, they donate to the local charity. Who in the hell in their right mind would drive out the rich people? I mean, Florida and places like that are very shrewd, and places like California are being very stupid. It's contrary to the interests of the state.
One more question for you. Jack Robbins asks, how will a 25 to 28% corporate tax rate affect Berkshire's companies?
Well, I don't think it would be the end of the world. We've adapted to the tax rate, whatever it is.
Yeah, I would say that if they raise the tax rate, they're owning the federal government's owning a larger percentage of business. I'm not saying what the tax rate is, but we have a Class A stock and a Class B stock. The U.S. government owns what I call the Class AA stock. And it's a very special stock. They get a percentage of the earnings, but they don't own the assets. And they don't vote on who gets to run the place or anything else. But if the government wants to take, when I was first starting, they used to take 52%, the federal government did, of corporate profits. And they've got, what would you pay to own the government's Class A, AA stock? If there was a public issue by the U.S. Treasury and they said this vehicle, given a name like SPAC or something even sexier, and all it will do is it owns the future tax payments of Berkshire Hathaway forever. And how much is that stock now worth, and it'll pay a big cash dividend, and they'll go up as we retain earnings and build the company and everything else. Well, it's worth more if the tax rate is 25% or 28% or 52% than at 21%. They own a special stock, and when people talk about how it all gets passed through the customer and everything, in the utility business it actually does. That's a special case. But it doesn't in most of our businesses. I mean, it's a corporate fiction when they put out statements about the fact that this will be terrible for all of you people. We pay more taxes. It hurts the Berkshire shareholders if rates are higher, and that may be quite appropriate. But to say otherwise is just it doesn't make any sense. I would love to see the government actually issue. They could have. I mean, they could set up a company, just call it the Berkshire Hathaway Tax Company, and it would take all the taxes we paid every year. How much would they be able to sell that asset for? They talk about unfunded obligations of the government. That's an unreported asset of the federal government. They own part of Berkshire, and they get to determine how much. I mean, it's an interesting question.
One last tax question. This one comes from William Barnard, who says, in the owner's manual portion of your annual report, Warren, you state, on my death, none of my stock will have to be sold to take care of the cash bequests I've made or for taxes. Would the recent Biden proposal to treat unrealized gains as sold and taxable at death at a 43.4% rate change the amount of stock required to be sold for payment of taxes upon your death?
Yeah, well, the tax law can be changed tomorrow. And it can be done a lot of different ways, and it's been done a lot of different ways in the past. I can tell you, I can actually make a promise to society that 99.7% of what I have when I die will either go to philanthropy or to the federal government. And the federal government can actually determine the rules on that. And I would prefer that it would go to philanthropy. I think it actually will accomplish more utility if it goes to be used by some smart people in philanthropy than if it simply reduces the federal debt by $100 billion or something when I die. I don't think it makes a damn bit of difference. Whether the federal debt is $100 billion higher or lower, it won't change anything in the world. And at present days, it doesn't really save them anything because they can borrow $100 billion. It doesn't cost them anything anyway. But that condition won't prevail. But I would not regard it. I'm just talking personally. I'm not advocating this public policy, but I wouldn't. If they took it all, it would not bother me. I mean,
I guarantee it won't bother you.
Yeah, that's what Charlie wants. Charlie says you won't know. But if you decide, if American democracy decides that it's better to take it all, which I don't think they will, and I don't think they should, but nevertheless, so what? And I would like to see it used to accomplish the most for humanity. I mean, and that means having smart people, properly motivated, and more importantly, not improperly motivated, distribute it in a way, and who knows what the hell it would be 10, 20, 30, or 40 years from now. I do know if it goes to the government, it reduces the national debt by that amount. I don't think it changes whether they change minimum wage laws or does anything else. I just think a little figure changes. It'll be, it'll show up in the budget one day, received from Buffett, X, and then some huge figure appears down below. I don't think it really. So I would prefer it be used privately, but that's really up to the people of the United States to decide through their representatives.
This next question's for Ajit. It comes from Professor Don Wunsch at the Missouri University of Science and Technology, who says, Mr. Jain, what has COVID-19 taught us about systemic and correlated risk, and is there anything that we will do differently from now on?
Yeah, in the insurance business, we often think about pandemic risk as one of the risk factors that we need to cope with in our business. Having said that, I think the big lesson for us, having gone through what we've gone through recently, is that while we were aware of the fact that pandemic risk is a risk factor, it was totally underpriced by all of us in the industry. Several of us thought it's an event that will happen at most once in 100 years. And even then, those odds are pretty high. So I think the big lesson for us is to recalibrate and rethink about what the return time is for something like a pandemic risk. And separately, we haven't yet done a good enough job as an industry, I'm saying, in terms of correlating the risk and aggregating the risk and making sure we can deal with the aggregate numbers. For example, pandemic risk has obviously taken people's lives, but then separately a bunch of us used to write something called event cancellation or contingency policies. And in terms of pricing for the contingency policies, like the Olympics being canceled, NBC would buy insurance for their rights, which might suddenly be not worth much. And when pricing something like that, we would think in terms of earthquake and risk and more recently terrorism, but we would never factor something like what portion of the price should come from the pandemic exposure. So I think the industry will become a lot more sophisticated in terms of thinking through what is the impact of pandemic risks across the entire portfolio, as opposed to it just being localized to one or two areas.
And I'm sorry, Don asked if anyone else on the stage wanted to comment after Ajit on that same topic.
I missed that.
Oh, he was just looking if anyone else on the stage wanted to comment on that.
Well, as Ajit mentioned, people were throwing in, an event cancellation. I mean, lots of people buy insurance against the Olympics being canceled or the United States not participating. I mean, they try to think of all kinds of risks because they have ad campaigns based upon all. So there's a lot of event cancellation insurance, and it was probably underpriced the implicit part of that premium that was attributable to a pandemic risk. I mean, Bill Gates gave a terrific talk at TED 5 or 6 years ago, and people ignored it. And it's very interesting because this isn't a worst case what we've seen, and yet it's staggering in terms of what has happened, and people that wrote insurance that they may have found out sometimes that they were covering things they didn't even intend to cover, and maybe the insurance didn't think they were buying, but nevertheless, after the event occurs, that they get very inventive in coming after them. There are certain risks too that are just too big. The nuclear risk, for example, I mean, the federal government is very early on, they recognized that the private insurance industry, they can't handle the risk involved in the financial risk that would be involved in terms of a massive nuclear strike or something like that. So it's the pandemics. The wording will be much more careful in future policies on trying to define it very precisely. And incidentally, I mean, in the way the cases have come so far, in the United Kingdom, and I think there was one particular insurer. I mean, the cases are coming down much tougher on insurers. In the United States, I mean, the policies were just written differently. You don't get insurance against something you don't buy against for, and generally the court decisions have come down favorable to insurers, and at Berkshire, it just so happens we are not a big player, but that's in commercial multiple peril, which might be where it is not a huge factor for Berkshire.
This follow-up question is from Martin Devine, and he asked both Ajit and Warren, what's your best estimate of Berkshire's insurance claim exposure from the COVID-19 pandemic?
Well, in terms of reserves, starting from last year to the end of the first quarter this year, we have put up $1.6 billion and change in terms of reserves. Now, what that doesn't take into account is some of the frequency benefit because of COVID-19 that results because of fewer accidents. And GEICO has had a huge tailwind because of that. But in terms of what the insurance operations collectively are going to be writing checks for, that number, as of now, is about $1.6 billion. And my guess is that will probably grow. Because if you look upon it, the industry as a whole has reserved, we've reserved 1.6, as I mentioned. The industry as a whole has reserved about $25 to $30 billion for COVID-19 as of now. If you believe the pundits in the industry, they will tell you that number is probably going to be closer to $100 billion. So there's another about $75 billion of COVID-19 losses that need to flow through insurance industry's balance sheet and income statement. Our number, therefore, of 1.6 that we have as of now is going to be a lot higher, but it's not something that we cannot manage completely.
Yeah, we will not be in the top 5 payers of, my guess, of insurance claims, even though we write a much smaller amount of both life insurance and annuities, actually. And in the end, we had more life insurance claims, but the annuities are not going to last. More people will have died that would have otherwise got payments under annuities. It cuts a lot of ways. It's a one of the great human catastrophes of all time, but it is not. It's not that big an insurance. And I would say this: if the insurance industry thinks they're going to lose $100 billion, the $100 billion ought to be up on their books now. I mean, the idea of feeding in losses, you've got a liability, and our goal is not. Our goal is to put up the liability when we think it's happened, and then if we should not be at $1.6 billion, I would say this: if we really think we're going to have some proportional share of $100 billion, well, that's enough said on
that. This next question is for Greg, but also for Warren and Charlie. It's from Blair Miller, who asks, what does the combination of Kansas City Southern with either Canadian Pacific or Canadian National mean to BNSF in terms of competition? And do you think the synergies of the merger will justify the multiple paid?
Sure. So it's obviously a transaction we followed very closely with both Canadian National and Canadian Pacific bidding to purchase Kansas City Southern. Either of those companies acquiring Kansas City Southern will have an impact on BNSF. What they're basically proposing is to create a north-south railway that goes from Canada into Mexico. We do have a strong presence in Mexico, not as strong as some of our competition, but we would feel competition there. So we'll follow that transaction very closely. As it goes before the Surface Transportation Board, the standard that will be applied is that competition has to be protected or enhanced. So that's our opportunity to protect our franchise on behalf of our customers. So we move intermodal business both in and out of there on behalf of certain customers. We'll want to protect the rights of our customers there. So we'll be active in the approval process, but there's no question in the end it impacts our franchise. Warren?
Yeah, it's not huge, but it affects both the Union Pacific and BNSF to a small degree, a relatively small degree. But that's not really the worry of the Surface Transportation Board. Their job is to do what's best for the shippers. And in terms of the price that's being paid, but like I say, if you can borrow all the money for nothing, it really doesn't make much difference to people. And this would not be being paid under a different interest rate environment. I mean, it's very simple. But it would make there's no magic to the Kansas City Southern. It's got I think their deal with Mexico ends in 2047, and that I mean, it will it's the number of carloads carried and everything. It's not going to change that much, but it is kind of interesting. There's two major Canadian what they call Class 1 railroads, and there's 5 in the United States, and this will result, in essentially 3 of the units being Canadian, 4 being U.S., which is not the way you normally think of the way the development of the railroad system would work in the United States. But it's, we've talked about it plenty, and CP or either Canadian Pacific or Canadian National is very likely to get it. I think the Surface Transportation Board voted for it, didn't they, the other day? Didn't get. Am I correct on?
They voted on an initial trust structure that they had to approve for Canadian Pacific, and that was a 4-1 vote, as you noted, Warren. So they're moving forward with the evaluation of it.
Yeah, and normally railroad deals are very long, take a long time for them to evaluate. But in this case, I think they have two opposing trust proposals, and in effect, by if they make a quick decision on which trust proposal that they allow, I don't say you allow 2 proposals exactly. So it may be a very accelerated decision. I don't know, but it's up to the Surface Transportation Board to do what's best for what their obligation is to the country to do.
There was a follow-up question on that. Do you
Sure.
think the valuation that they're paying is worth it?
Well, we, in a very, very mild way, I mean, everybody's contemplated making deals with different railroads, ever since I've been in the railroad business. We've talked about it. When CP, when was Hunter Harrison came after, was it Hunter that did on CP that kind of led the way, and we looked at buying CP. I mean, everybody looks at everything, and we would not pay this price, and it implies a price for BNSF that's even higher than what the UP is selling for. But it's kind of play money to some degree. I mean, when interest rates are this low, and I'm sure from the standpoint of both CP and CN, there's only one KC Southern, and they're not going to get a chance to expand it. They're not going to buy us. They're not going to buy the UP, and the juices flow, and the prices go up, and
they're buying with somebody else's money.
Yeah, it's somebody else's money, and you're going to retire in 5 or 10 years, and people are not going to remember what you paid, but they're going to remember whether you built a larger system, and the investment bankers are cheering you on at every move. They're saying you could pay more, and this is they're moving the figures around, the spreadsheets are out, and the fees are flowing.
This question comes from Asher Haft in Brooklyn, who says, Asher's been a shareholder since 2006, says that he appreciates your honesty and candidness when it comes to explaining costly errors you made. In this year's chairman letter, you discussed that you made a mistake in 2016 when calculating Precision Castparts' average amount of future earnings, which resulted in Berkshire overpaying to acquire it. It appears that Precision's earnings declined substantially in 2020 because of the pandemic and the effect of airline and travel industry. What calculations could you have made in 2016 that might have altered your decision to acquire it? And secondly, are the problems Precision is currently facing larger than the pandemic?
Well, Berkshire didn't make the mistake. I made the mistake, incidentally. Anytime we look at buying a business, we're evaluating the competitive strengths of the business, the price we have to pay, the management we get, and everything. And we didn't make a mistake on the management, but in terms of the earning power on average, and when Boeing has troubles with the MAX, well, that's a probability. I mean, anytime any customer is a big, I mean, all kinds of things can happen, and we have seen some of those things happen, and therefore I paid too much in relation to average earnings. It's a terrific company, and I'm happy with the management and everything, but GE doesn't need as many engines as we thought it would need, and they get into the power business and a variety of things, and we knew they're in the businesses, but we did not think those businesses would necessarily be in something close to a depression when other businesses are that we bought end up sometimes doing better than we think. But we'll continue making mistakes. I mean, and I shouldn't say we will. I will. But even these other guys.
The rest of us will help.
and we'll, we've got some wonderful deals and some terrible deals, and the nice thing about it is, as I pointed out, this doesn't really apply in the case of Precision precisely, but when we're disappointed in a business, it usually becomes a smaller and smaller percentage of our business just by the nature of things, because it isn't going anyplace. And when we get a successful business like a Geico or something of the sort, Geico's they're doing 15 times as much business as when we bought control in 1990. They become a proportionally much more important part of our mix. So you really get, through just natural forces, you get more of your money in the things that have developed more favorably than you thought. You actually end up getting a greater concentration in the ones that work out. It's not like, as Charlie would say, it's not like having children. I mean, the ones the bad ones cause you more problems. But in the children of businesses, the small ones kind of. By the way, we started with 3 businesses, Charlie and I, and Berkshire was textiles, Diversified Retailing was a department store, and Trading Stamps were Blue Chips business. And those were the 3 companies we put together, and all 3 of the original businesses failed, which sort of gets me in terms of the people that are worried about don't we know that coal is going to be phased out over time? Of course we know coal is going to be, but that doesn't mean we're going to be phased out over time. I mean, that every business has some things to think about that way. The biggest danger, they have that section in the prospectus called, what do they call that? About certain
Risk factors.
But risk factors, yeah. The number one risk factor, you never see it. The number one risk factor is that this business gets the wrong management, and you get a guy or a woman in charge of it that they're personable. The directors like them. They don't know what they're doing, but they know how to put on an appearance. That's the biggest single danger of the business, and if that person stays and runs it for 10 or 15 years and either stays in the textile business or department store business and expands. I've looked at a lot of businesses, and that's what's caused the number one problem. And it isn't the kind of thing where they list them all because the lawyers tell them to list them.
This question comes from Raghu Bashwal, and it's for both Warren and Charlie. Now that the crypto market overall is valued at $2 trillion, do you still consider cryptos as worthless artificial gold?
Well, I knew there'd be a question on Bitcoin or crypto. And I thought to myself, well, I've watched these politicians dodge questions all the time, and I always find it kind of disgusting when they do it. But the truth is, I'm going to dodge that question because we probably got hundreds of thousands of people watching this that own Bitcoin, and we've probably got 2 people that are short. So we got a choice of making 400,000 people mad at us and unhappy, or making 2 people happy, and that's just a dumb equation. So I thought about it. We had a governor one time in Nebraska, and a long time ago, but he would get a tough question. What do you think about property taxes, or what should we do about schools? And he'd look right at the person. He'd say, "I'm all right on that one," and then he'd just walk off. Well, I'm all right on that one, and maybe we'll see how Charlie is.
Well, those who know me well are just waving the red flag of the bull. Of course, I hate the Bitcoin success. And I don't welcome a currency that's so useful to kidnappers and extortionists and so forth, nor do I like just shuffling out a few extra billions and billions and billions of dollars to somebody who just invented a new financial product out of thin air. So I think I should say modestly that I think the whole damn development is disgusting and contrary to the interests of civilization. And I'll leave the criticism to others.
I'm all right on that one.
The next question that comes in, or the next series of questions, are from James Hernandez. He has two questions, one for Ajit, one for Greg. They both concern Elon Musk. For Greg, this question is for you. Elon Musk has stated that Berkshire Hathaway's energy proposal for Texas, spending more than $9 billion for new generating capacity, is wrong. Instead, Mr. Musk argues that load balancing using battery storage is the appropriate course of action. Can you explain why the BHE proposal is the better course of action for Governor Abbott in the state of Texas? Specifically, what amount of savings can the citizens of Texas expect above and beyond what Mr. Musk is proposing?
Sure. So obviously there is a very unfortunate event in Texas in February, and it basically lasted 4 days. Many lives were lost. The economic damage was significant. Texas has highlighted that anywhere from 80 to $130 billion in incurred losses over that period of time. And I think when you look at the power sector, it fundamentally let the citizens down. It didn't perform as they expected. And then when it did perform, it was extremely expensive. They incurred billions and billions of dollars of energy costs versus a multiple of basically 10 times what they paid. They paid 10 times in energy costs over those 4 days what they paid in the past year. So a very substantial event for Texas. We've gone to Texas with what we believe is a good solution. We spent a lot of time pulling it together, understanding the fundamental issues around it. And our proposal is really based upon the fact that the health and welfare of Texans were at risk, and we needed to have effectively an insurance policy in place for them, that if they needed the power on very short notice, it would be able to be dispatched and it would be there for the 4 days. We're actually proposing it could be there for 7 days. And the fundamental concept of our proposal has always been, if there's a better proposal that's brought forward, we've accomplished our mission. We've just been really there to, it's the best proposal or option we could come up with, and obviously if Texas or Elon or someone else comes up with a better proposition, we've always said, Texas, you should pursue it. We strongly believe right now we have what remains is a very good proposal for Texas, and it'll continue to be discussed and evaluated. The big difference between a battery proposal and our proposal is that we will have power that can be generated continuously for 7 consistent days, where if you went to a battery solution, you may release that power that's been stored for 4 hours, but we're talking 4 days of a problem, not 4 hours. And it's just a completely different cost equation and solution. So very proud that our teams brought forward what I thought was a very unique solution. We've worked hard with our suppliers and Peter Kiewit and Sons to put together what we believe is a firm cost that can also be delivered by November of 23. So again, we put a firm date on. It won't be ready next winter, unfortunately. It won't be ready this summer, but it's a valuable solution, and one that we hope at least leads to the right discussion and the right long-term solution for the state.
Yeah, and we're also willing to put up $4 billion that if we don't deliver when we say we're going to deliver, we'll pay it as a penalty, basically. But you know, we went to Kiewit, we went to General Electric and said, you know, how long can we get turbines? And for that, if you're going to be prepared for 2023, you have to start at a point fairly soon, and you have inflation going on, and Kiewit's not going to change things on us in a month. We don't try to get the contracts all written out, but they had 100 people working on it.
Yeah, they had hundreds working on it.
And GE's cooperative and everything. But doesn't mean we have the best solution. We just know what we can do. And if anybody can do it faster, they can do it cheaper, whatever. that's terrific. But they should have something to lose, though, if they don't do it. I mean, and we will back our promise up by $4 billion, which, and we won't have any rinky-dink clauses in there that if this happens or that happens, we don't pay. Well, but we won't be able to do that a year from now. I mean, we can do it a year from now with the costs then from what they are then, and then it'll be a year further out. We want Texas. Texas is a terrific place to do business. We do a lot of business there, and it's where BNSF is headquartered. And it's a great place. And this was out of the blue, but one way or another, the nature of utility business is that you have to be prepared for something that probably isn't going to happen. And you don't want to say it's a 1 in 30-year event, and people die. I mean, you want a margin of safety in it, and we've got one solution, and other people may have other solutions, and we will cheer when a solution is reached of any kind, and we will cheer a little louder if it's ours.
Ajit, your question from this gentleman. Suppose the hypothetical situation arises where Warren Buffett calls you on the phone to tell you that Elon Musk has contacted him about writing an insurance policy on his proposed mission to and subsequent colonization of Mars. Specifically, he wants insurance to insure his SpaceX Heavy rocket, capsule, payload, and human capital. Would you underwrite any portion of a venture like that?
This is an easy one. No, thank you. I'll pass.
Well, I would say it would depend on the premium, and I would say that I would probably have a somewhat different rate if Elon was on board or not on board. I mean, it makes a difference. I mean, if somebody's asking you to insure something, so I would. That's called getting skin in the game, and
But in general, I would be very concerned about writing an insurance policy where Elon Musk is on the other side.
Okay.
Tell Elon to call me instead of Ajit.
This question comes from Michael Liu from California. This is for both Warren and Charlie. In your shareholder letter, you mentioned that the best investment results come from the companies that require minimum assets to conduct high-margin businesses. In today's world, many of these companies tend to be software-driven businesses. While Berkshire has avoided investing in high-growth technology companies in the past, this appears to be slowly changing with your investments in Apple and Snowflake. As shareholders, should we expect that high-margin businesses will begin to constitute a larger proportion of Berkshire's investment portfolio over time, particularly as Todd and Ted take on larger roles in the investment decision process?
Well, we've always known that the dream business is the one that takes very little capital and grows a lot. And Apple and Google and Microsoft and Facebook are terrific examples of that. I mean, Apple has $37 billion in property, plant, and equipment. Berkshire has $170 billion or something like that, and they're going to make a lot more money than we do. They're in better business. It's a much better business than we have. And so in Microsoft's business is a way better business than we have. Google's business is a way better business. We've always looked, we've known that a long time. We found that out with See's Candy in 1972. I mean, See's Candy just doesn't require that much capital. It doesn't have, it has obviously a couple of manufacturing plants, they call them kitchens, and but it doesn't have big. It doesn't have big inventories except seasonally, for a short period. It doesn't have a lot of receivables. So those are the kind of businesses. They're the best businesses, but they command the best prices too. And there aren't that many of them, and they don't always stay that way. So we're looking for them all the time, and we've got a few that are pretty darn good, but we don't have anything as big as the big guys. But that's what everybody's looking for. That's what capitalism is about, people getting a return on capital. and the way you get it is having something that doesn't take too much capital. I mean, if you have to really put out tons and tons of capital, the utility business that way, it's not a super high return business. You just have to put out a lot of capital. You get a return on that capital, but you don't get fabulous returns. You don't get Google-like returns, or anything remotely close to it. We're proposing a return in the transaction with the proposition with Texas. I think it's a 9.3%.
Yeah, 9.3.
Yeah, and that. But if you look at the return on most American businesses on net tangible assets, it's a lot higher than 9.3. But they aren't utility businesses either.
Charlie, did you want to add anything to that?
No, thank you.
Okay. This question is from Ryan Fasaro in New York City, who says Todd and Ted have taken on increased responsibility at Berkshire over the years, managing larger pools of capital, including the company's sizable Apple holdings, participating in M&A strategy, and even overseeing the company's now shuttered healthcare partnership with Amazon and J.P. Morgan. We are grateful for their efforts, but Todd and Ted are still not made available to shareholders at the annual meeting each year. Given their growing importance to the firm, can you discuss this policy and whether we can expect to hear from them more in the coming years?
They're both absolutely terrific. And that's one reason I don't want people quizzing them on stocks. They are assets of Berkshire. And just there's no reason for them to be out educating other people on how to compete with us. And it wouldn't. It always seems so silly that people expect. They don't expect Merck or Pfizer or something to tell them exactly what their scientists are working on, and where they stand and where the failures have been, so they can eliminate those. Yeah, if you've got talent that knows how to evaluate businesses, and those two fellows they've gone far beyond that. They're terrific assets, and they love Berkshire, and they work extraordinary hours. But we don't really want them going around with people asking them questions about why you like this industry better than that industry or anything of the sort.
This question's for Charlie. It comes from Stephen Tedder in Atlanta. He's been a Berkshire shareholder for 10 years and says, you and your friend Li Lu have been very optimistic with respect to investing opportunities in China. BYD has performed spectacularly for Berkshire since its initial purchase in 2008 and is currently valued at $5.8 billion. The Daily Journal recently bought a large position in Alibaba after founder Jack Ma had been reprimanded by the Chinese Communist Party, and Ma's other company, Ant, was not allowed to proceed with its IPO. What are your current thoughts on China and whether the communist leaders will allow businesses with strong leadership to flourish in decades to come?
Well, I think that the Chinese government will allow businesses to flourish. It was one of the most remarkable things that ever happened in the history of the world when a bunch of committed communists just looked at the prosperity of places like Singapore and said, the hell with this, we're not going to stay here in poverty. We're going to copy what works. And they changed communism. They just accepted Adam Smith and added it to their communism. And said, now we have communism with Chinese characteristics, which is China with a free market with a bunch of billionaires and so forth. And they made that shift. They deserve a lot of credit. Warren and I are not quite as good at that as changing our minds in many cases.
Yeah.
And that was a remarkable change coming from such a place. And, of course, it's worked like gangbusters. It had this enormous growth in the average income of the average Chinese. They've lifted 800 million people out of poverty fast. And there was never anything like it in the history of the world. So my hat is off to the Chinese. And I think they will continue to allow people to make money. They've learned it works. The Chinese, I loved what the guy said in the first place. I don't care whether the cat is black and white as long as it catches mice. That's my kind of talk.
In that list of the 20 most valuable companies, just 3 are Chinese. Now, if you're looking out 30 years, how many do you think will be Chinese? My guess is more, but I don't think they'll top the United States. But who knows? It's amazing what has been accomplished, and
really amazing.
And they found what works. I mean, there's nothing like finding something that works in order to sort of reinforce ideas over time, and we'll see what happens. But I would bet there will be more than 3. But I will bet the United States has more than China has too.
This one comes from Tim Medley. Tim Medley in Jackson, Mississippi, who's been a Berkshire shareholder since 1987. He writes, on March 19th, respected economist Larry Summers, the former president of Harvard University and the former secretary of the Treasury under President Obama, was critical of President Joe Biden's $1.9 trillion American Rescue Stimulus Plan. In an interview with Bloomberg Television, he said, I am much more worried that we will have more inflation or that we will have a pretty dramatic fiscal monetary collision. This goes way beyond what is necessary. He said also, this is the least responsible macroeconomic policy we've had in the last 40 years. Your thoughts?
You're asking me on that?
He didn't write to who, so I guess it's anybody on the stage.
I would say that Larry's been reading his uncle's book, which was Paul Samuelson. But no, Larry is a very, very, very smart fellow, and he's laying out possibilities which actually now have probably been voiced a little more even since that March 19th or whatever date it was that he made that. You can't just do one thing in economics, and if we really could shovel out more and more debt, and the carrying cost turned out to be something very low. People thought Japan couldn't do what they've done, but it used to be called the Widowmaker and around Solomon, and people were shorting Japanese bonds, but the answer is we don't know. But Larry's view is an important view, and it's just as good as probably the view on the other side might be. We don't know what happens from the present policies. We do know, as Jay Powell said the other day, the idea that 100% of GDP was some terribly dangerous level for in terms of debt, and that doesn't really make a whole lot of sense now, and that used to be kind of accepted wisdom. We've learned that a lot of things we thought before weren't true, but what we haven't learned yet is whether what we're doing now is true. And the best thing to do is recognize you don't know and proceed in a way where you get a decent result no matter what happens, and that's what we try and do at Berkshire Hathaway. We do not think we can make money by making macroeconomic predictions. We do think we can be pretty darn sure we'll get a reasonable result under policies that will not maximize result if we could do that sort of thing.
It's not at all clear whether Larry is right or wrong, and
he's a smart man, though.
He is a smart man.
Yeah,
and it's courageous of him to raising it to. He's practically the only one talking that way, which I admire, by the way.
Yeah, it guarantees he won't get a position in the administration.
Yes. Well, that's one of the reasons I admire him.
Yeah.
And not that there was anything wrong with having a position in the administration, but I think people who kind of tell the way they think it is, I like it.
This question circles back to banking, which you touched on earlier, but Jerome Bernard from Switzerland writes, could you please explain why you decided to exit most of your bank stocks in 2020, except for Bank of America, and what's your view on the future of the banking industry?
I like banks generally. I just didn't like the proportion we had in it compared to the possible risk if we got bad results that did not. So far, we haven't gotten. So we were over 10% of Bank of America. It's a real pain in the neck to both to the bank and more to the banks than to us if we go over 10%. There's just a whole lot of, and I like the Bank of America. I mean, I like Brian Moynihan very much, and I like the banking business fine. So we took that up, but we took the overall bank position down. We didn't want to go above 10 in any of the others, and we did want to increase the B of A position, but we overall didn't want as much in banks as we had. We like the banking business is way better than it was in the United States 10 or 15 years ago. The banking business around the world, in various places, might worry me, but our banks are in far, far better shape than 10 or 15 years ago. But when things froze for a short period of time, the biggest thing the banks had going for him is that the Federal Reserve was behind him. And the Federal Reserve is not, they're not behind Berkshire. It's up to us to take care of ourselves.
This question comes from Matt Y. in Los Angeles. You recently purchased a large stake in Verizon. For educational purposes, could you please explain your thinking behind this investment? In general, many people see telecoms as dumb pipes that have to spend heavily on CapEx building out the 5G infrastructure, only for the other tech companies to take advantage and capture most of the value created from the infrastructure, like Facebook, Uber, Airbnb, and DoorDash.
Well, I think he's analyzed the situation well, but we are not in the business of explaining why we own a stock which we either might buy more of or sell or who knows what. So he's on his own, but he sounds like he's very capable of thinking it through very well himself.
Slavin Vukobrat writes, Senator Josh Hawley recently unveiled a new antitrust proposal that would ban mergers and acquisitions by firms with a market capitalization over $100 billion. While this legislation is unlikely to go through, increasing antitrust regulation could represent a material risk for Berkshire. Has Berkshire's board already discussed what would happen to the company over the long term if Berkshire was to be prevented from acquiring controlled businesses?
Well, we don't discuss that as a specific, but the board is very, very, very familiar with what Berkshire does, why they do it, how we think in deploying capital. But we could, everybody knows that if you change the antitrust laws, it can change things for Berkshire. If they change the tax laws, it can change things for Berkshire. There's a lot of things, and we could spend hours discussing them. But in the end, is it a 22.3% risk that something changes? It's a good way to fill the time at board meetings. And if you're getting $300,000 or $400,000 a year as a board director, you might want to spend your time doing that. But we really don't focus on that. The main thing about Berkshire is how do you preserve the culture? How do you make sure that if you get the wrong person as the CEO, you can do something about it? That's the biggest risk a board has, is if you pick the wrong CEO. And I've been on 20 boards, and it's happened more than once. And sometimes it's a terrible problem to get rid of them. Years go by, and if a dissident comes in, it's one thing. But if you just sit there and you collect your $300,000 or $400,000 a year, and the chief executive keeps proposing you get an increase time to time, and it's worse yet if he's a nice person, doing his best. But we're not going to spend a lot of time. We may do it on a personal basis, but we're not going to take a lot of people. And we want them to know more about what's going on with BNSF and how Katie's doing, and whether the KCS thing can injure us in any material way, and so on. And we really don't, except maybe on a private side thing, we don't start talking about what the effects will be in 2050 if this projection or that projection is met. Charlie,
nothing to add.
Okay. This question was sent in by Don Graham during the meeting based on something you said earlier today. And he says, why does Warren say Berkshire's ability to insure enormous risk quickly is a less valuable asset than it used to be?
Well, because the demand is less. I mean, basically on that. If you take a period like happened after 9/11, I remember, I may be wrong on the details of this, but Cathay Pacific, for example, they couldn't land in Hong Kong, as I remember, unless they had an insurance policy by Monday of the following week. Well, we can do it. G calls me up, and he thinks of a price, and I think of a price, but we can do it. We can take the loss if it happens. They called us on the Sears Tower, I think, back then. After that, nobody knew. They didn't know whether bombs might be placed all over that. So, and they wanted more insurance all of a sudden, and we gave them a price. And so that sort of an environment hasn't really persisted. I mean, there were times, I think, perhaps AIG, when Hank Greenberg was there, he would do the same thing. But there weren't 10 or 20 people out there, and they needed big limits in some cases. And we were good for it. And they knew that if they bought the insurance and it happened, we'd write a check and it would clear. Gene, you might have some.
Yeah, in addition to the demand side, the supply side has become a lot more